But one of the things that I did is I looked at withdrawal analysis for 5 different funds. I took 5 different covered call funds, and I said, okay, what happens if you're living off the yield? Now, and then I said, let's match those exact cash flows from someone who's investing in the underlying and see who comes out with more wealth. They're spending the same amount in both cases based on the yield of the covered call fund. And let's see who has more wealth after 10 years. In all 5 examples, the underlying investor, not the covered call investor, had more wealth. So they'd spent the same amount and they had more left over, which is not surprising. And then the thing that I did that was interesting, and we touched on this a little bit in our episode on this topic, Dan, is I looked at how much HISA, how much cash basically, would the investor in the underlying assets have to be holding such that the ending wealth of the underlying investor and the covered call investor was the same. And again, we mentioned a number similar to this in our episode. It was on average 26%. So you had to be holding 26% cash and the remainder in equities to match the ending wealth of investing in covered calls. Now we talk about, is that detrimental? I mean, man, holding a 30% cash allocation for a long-term investor is like, that's one of the worst things that you can do. That's very different from investing in dividend stocks.